If you've been tuning into some of the bigger real estate investing influencers online recently, you may have noticed a trend. Many are recommending not to invest in real estate in 2026. Seems like this is the popular sentiment right now. And I want to do this video because if you're just getting into real estate investing, this could be pretty discouraging for you to hear all these people talking negative about it. And so I want to share maybe another perspective. So I want you to keep in mind that these are influencers. They're really big influencers, which means that they make a lot of their money, if not most of their money, from the platforms themselves, from YouTube. YouTube pays them for all the clicks, likes, and subscribers. And so they need to fuel the algorithm. And so if they've done some bad deals themselves over the years, and they look over here and they see I'm making millions from my social media following, then yeah, maybe it doesn't make sense for them to do real estate anymore. But I wouldn't say that that's good advice for everybody. And I also wouldn't say that all real estate is created equal. So I'd like to share with you a counter perspective from someone who's definitely not a big influencer. I make almost nothing from YouTube, but my entire life and my financial future has been changed as a result of buying the right properties. And about 5 years ago, my wife and I got to a place of being financially free and being able to leave our full-time jobs and live off the income from investing again in the right properties, because not all real estate is created equal. So in this video, I want to walk you through the difference between buying any old property, which I don't think is a good idea in 2026, and buying the right types of properties. And by the way, if you listen to this and the type of property that we invest in really resonates with you and you want to buy that specific type, because we're extremely specific on the type of property that really makes the most sense in 2026 and going forward, in my opinion, then you can set up a call with me and talk through our blueprint program. I've worked with now hundreds of people since we got to a place of financial freedom 5 years ago, and I've walked them through the steps of how to find, buy, and set up this type of property. And so if that's interesting to you, if this video really resonates with you, you can go to the link in the description below. You can set up a call with me or my teammate, and we can talk through the details of the program and see if it's a good fit for your goals. So I think there's really three main aspects that separate out the types of deals that are really worthwhile to invest in today in 2026, and the rest, which I think is the vast majority that maybe aren't worthwhile. But the ones that are worthwhile are really worthwhile. So I'm going to walk you through these three main aspects to think about. Number one is the age-old debate of invest for cash flow versus invest for equity. And I'll say right up front, I'm a huge invest for cash flow type person. I invest for massive cash flow, and I'm going to share how I do that and what type of numbers I'm looking for on a deal, because I feel like that's the insurance policy on that deal. You know that there's money coming in that you can reinvest over and over every single month that's hitting your account. I feel like equity is speculation. And it's funny because I just read an article on BiggerPockets just over the last year that said cash flow is a myth. That was the title of the article. It was from, I think it was the CEO, the current CEO of BiggerPockets. They talked through how just cash flow doesn't exist today. So you have to just run your numbers based off of the hope for future equity, I guess. And I agree with that, actually. If you're buying the traditional or the typical single family long-term rental or even a commercial property, it can be really difficult to cash flow under the current market conditions. But that's why you have to get a little bit creative on the type of property that you purchase. And now we're seeing from a lot of these people who are the biggest downers on real estate right now, who have always traditionally invested kind of based off of equity and gains on the property, and they look like geniuses from 2012 to 2022-ish, that whole decade when conditions were improving every single year and properties were appreciating. It's easy to look like a genius then. And if you're investing and taking a ton of risk based off of the gains and the improvement in the market and the gains that you're going to get as a result of that, then yeah, you look really smart, but you're also taking a lot of risk. And now we're kind of seeing a lot of those people kind of struggle. One of the famous examples of that is Brandon Turner right now, who, got famous through BiggerPockets podcast. He started a fund, he raised a bunch of money, and he recently lost $15 million on one deal of his investors' money. And he did an Instagram post that said, "Sorry guys, I lost this money for you, but I still love you." And so there was a lot of discussion online, a lot of controversy around this, and people saying, should he have done this or shouldn't he have done this? Bottom line is, in order to be able to make that much money, you have to be willing to lose your investors' money, which a lot of times is family and friends type of money. So you have to be okay with that, which a lot of people are. Personally, I'm not okay with that. I would never be willing to take that much money, even if the upside was great, just because I couldn't live with myself if I lost that type of money. So I only take loans that I know I can pay back, and they're secured on really fundamentally sound deals that we're buying for a really great deal that produce significant cash flow way beyond what I owe the lender. So there could always be a black swan scenario where you still lose money on a deal, but I know that I would pay back every single penny of anything that I owe, because I'm never going to raise that type of money that it takes to put together one of these commercial deals that in the wrong market conditions can go sideways and you lose millions of your investors' money. So instead, what do I recommend focusing on, or what type of deal does make sense in 2026? So here's a perfect example of the type of deal that I highly recommend, of a property that cash flows phenomenally well, that's going to be an incredible investment long-term. It's an incredible investment today and long-term. And this is a deal that literally just 3 days ago on one of my Q&A calls with the members of my program, a member of my Blueprint program, Therese, she brought this deal. And this is her second deal in this same market. So let me switch my screen and I'll share with you this deal. So this property, you can see, is in Sioux Falls, South Dakota. So a lot of the big influencers who are talking about how terrible real estate is, they're investing in like big markets like LA or Las Vegas or some of the, mainstream Florida markets, some of the areas that have been hit really hard. They're not investing in these stable markets that are tried and true and produce significant cash flow. So I think that's one big difference right off the bat. And we focus primarily on short-term rentals that are high-performing short-term rentals. And so you wouldn't a lot of times think of short-term rentals in South Dakota, right? That's not like a primary vacation rental spot, but short-term rentals work for so many different reasons. So I want to walk you through this deal just real quick, just so you can see the type of performance that you can get from just a small deal like this. So this is a 2-unit deal that is totally, I shouldn't say totally turnkey, but it's very, very turnkey. I mean, there's always a few little tweaks that you need to make to a property, but upstairs, it's a 3-bedroom, 1-bath property. And then in the basement, it's another 1-bedroom, 1-bath property. And so you can rent out the 2 different units individually. This is a street view. Here's a guy posing for the Google Street View camera right in front of the house. Looks like a nice neighborhood, though. I always like to do the street view just to make sure you're buying in a decent neighborhood. Then I always like to go to AirDNA and just look at the averages for the submarket. So in Sioux Falls, there's 603 short-term rentals. There's a 60% average occupancy across all of them, and some of them are pretty garbage properties. So if you just take this seriously, you can definitely beat the average in most cases. And then the average of 139 per night. So not huge numbers, but a very affordable market. And then you can kind of look at the curve of the occupancy and see in different months what the averages are and when the peak season is and when the low season is, that sort of thing. So not a super seasonal market, but most markets kind of go up in the summertime when families travel. Then I always go over to Airbnb itself and I look at the comparable short-term rentals. And you can see there's a lot of them right around this property, right in the same neighborhood or similar neighborhood right across the street. And so I pull up properties that are very similar. So I pulled up 3-bedroom properties. This one has 104 reviews. And you can look at their calendar and see when they're booked out, at what price points they're booked out. Here's another 3-bedroom. I looked at 1-bedrooms as well, similar to what that lower unit would look like. Here's a 4-bedroom, only sleeps 7 guests, so similar to the 3-bedroom upstairs unit. Here's another 4-bedroom. Here's a 3-bedroom. And then here's a 4-bedroom. So, you can look at both individual units and then look at what would it rent out as all 4 bedrooms, 2-bath together as the super listing is what we call it, and get a really good idea of the numbers. And then you go over here and you can plug in the numbers. So when she sent over the numbers, this is what she had plugged in, and we adjusted them a little bit. I think hers were a little bit higher, and I encouraged her to be a little bit more conservative, but $232 purchase price. You can see what the taxes, insurance is, a $10,000 set aside for repairs. Like I said, there's going to be some tweaks. Got to put some furnishings into it, so $30,000 for the whole place to furnish both units. She's doing a 90% vacation home loan on it. And then what are the high season rates and what are the low season rates? And so at 185 and 120 for the high season for the 2 units, She's counting 150 days as the high season, so shorter time frame for the high season than the low season, and about an 80% occupancy. And she already owns a 2-unit in this market, so she understands what the demand is and how realistic this is. And so at these price points, 80% is pretty realistic. And then in the low season, which is actually the majority of the year, it's only 165 and 100 and a 50% occupancy. So half the time it's going to sit vacant. And so altogether, that's $65,000 of income plus another $6,800 for your cleaning fee. And so she's going to gross about $72,000. The expenses all calculate for the most part automatically. You got to plug in some of these, and you're not going to know exact, but you want to put a ballpark. And we always put in things like maintenance, even though lots of months you're not going to have any maintenance, but that's a set aside because you know you're going to eventually have a roof that wears out or a furnace that wears out. So you want to put that in there. And so on this property, for a $234,000 property, I don't know what she got it under contract for, it's going to generate $2,700 of net cash flow after everything on a monthly basis. So that's after your maintenance, that's after the cleaner fees, that's after, all of these expenses that we have in here, utilities, snow and lawn, consumables like paper towels, toilet paper, all that stuff that we calculated in, there's still $2,745 of profit, of net cash flow left over. That's a 45% cash on cash return. So that means because she's getting a 90% second home loan or vacation home loan, which, you can do a few of those and then you got to switch to DSCR loans typically, which is 20% down. But for the first few, you can do 90% loan. So you only have to put 10% down and then it's pretty turnkey. So very minimal cash out of pocket. So every dollar she invests, she's making 45% back in cash flow on a yearly basis. That doesn't count appreciation. All the equity investors out there, that's all cherry on top. This is just from cash flow. So it's going to appreciate. The principal is going to get paid off by her guests every month that she pays the mortgage. The principal goes down on that mortgage. There's a huge tax benefit that we'll talk about in a second. There's all kinds of benefits in addition to the cash flow, but you know that you've got $2,745 hitting your bank every month. And it'll be higher in the peak season, it'll be lower in the off season, but that's the average cash flow on a deal like this, which is phenomenal. We always look for 1% of the purchase price on a monthly basis for net cash flow. So 1% of this purchase price, $232,000, would be $2,300, right? That's 1% of this. That's what we try to target as the net cash flow, which is a very hard bar to achieve if you're just looking at traditional vacation rentals. But for a deal like this, the type of deals that we target, these small multi-units in these secondary markets, you can find some really phenomenal deals that meet, or in this case, exceed that threshold. So before we leave this whole cash flow versus equity debate, I just want you to do a quick thought exercise with me. All right. So if you're an equity investor and you purchase $1 million worth of property that doesn't cash flow because you're focused on buying properties in areas that really don't generate much cash flow, but over time, you're expecting them to appreciate. You're building equity. And let's say it goes up to $2 million and appreciates. And then something happens in the market and there's a 50% drop in the market. Like there's some disaster that breaks out, there's a COVID thing or, some new war or whatever it is, and it drops 50%. Most likely that's not going to happen, but what if it does? What does that look like for you? Well, you're back to basically where you started from. You're back to square one and you have no cash flow. But if you invest for cash flow and you bought $1 million, if you followed our strategy of the 1% net rule, that means you would only invest in properties. If you had $1 million worth of property, that means it would generate $10,000 on a monthly basis, right? That's 1% of $1 million. So if you're all in for $1 million, then you want to see at least $10,000 of net cash flow. And so if we were buying just based off the cash flow, we didn't care about appreciation. So we didn't care if the property appreciated at all. We know it's going to. We know that property does appreciate long-term. It always goes up, but it's different in different markets. And so we don't plan on that. And so we just had the 10,000 and then a 50% market crash comes, because a lot of people ask me all the time, what do you think the market's going to do? Do you think the market's going to go down? Is now a good time to buy? And I say, I don't really care what the market does. Like, do I have the $10,000 cash flow? Because if the market goes down 50%, I'm upside down. I just lost $500,000 on paper. And you know how that changes my life? Not one bit whatsoever. Like, I still have $10,000 a month coming in every single month going forward. And for a lot of people, that's financial freedom. $10,000 a month, you can find a way to live off that in a lot of cases. And so that doesn't change regardless of where the value, the underlying value of the asset is. We know long-term it's going to be a much higher, and your principal is going to get paid off and you're going to get the tax benefits, all that stuff. But we have that consistency of cash flow. And if you're buying the right properties like the one I just showed you, it actually still cash flows as a long-term rental in a worst case scenario, because if you're concerned that, hey, what if something changes with short-term rentals and you can't sustain that type of cash flow, as a worst case scenario, you could always convert it and you still have positive cash flow. You're not going to lose your properties like a lot of traditional short-term rentals out there, but you have significant cash flow as a short-term rental. The second big thing that separates the average properties today that probably aren't worthwhile to invest in and the ones that really make a lot of sense in 2026 is the type of property and the type of market that you're selecting. And I'm going to focus more on short-term rentals here because I think that's where there's a huge opportunity today. And same way, the majority of short-term rentals don't make sense today, but I think there's a small subset, if you buy a specific type of short-term rental, the type that we recommend, that can work phenomenally well. And I'll illustrate this point by an email that I literally just got this week from a short-term rental designer. So on his email subscription, and he sent out this email that talks about the amenities arms race. And I've mentioned this before as well, that the amenities in these mainstream short-term rental markets are an arms race. And he said what worked years ago is dead today. What works today is standard, and what wins tomorrow is already being built. And he uses mini golf as an example of one of these amenities in these mainstream markets. And he said a couple of years ago, you could have a flat grassy pad with a couple holes cut in and people got excited about that. You pull that same property up today and it's on page 14. And here's what's working right now. So now you need contoured shapes that you're hitting around corners. You need 3 or 4 holes, landscaping around the perimeter, and then lights at night for playing at night. He said, here's what's coming: 3-dimensional courses, hills, mounds, layered terrain, and that actually feels like an actual golf course. And he said, mini golf is just one example. There's the hot tub, fire pit, pickleball, like all of these amenities. What you had a few years ago doesn't cut it today. And so think about that. Think about, is that the race that you want to enter? Like, can you ever win? All of those things, like a mini golf course or any of those amenities that he mentioned, those are all capital expenditures that basically go to zero value. If you're saying 3 or 4 years from now, you've got to have something completely different, then all that money that you put in, and I see people putting in 6 figures worth of amenities into these properties, that's all a wash. It's all just chalk it up to a loss, and you're going to have to redo it with the latest amenity just to get on page 1. There's only one page 1 in every single market, right? So in the most popular mainstream short-term rental market, there's one page 1 where they're showing you the top 15, 20 short-term rentals, right? And it's just like Amazon. Like if you have a product you're selling on Amazon, you need to be on page 1 because people don't scroll through to the 14th page to see your listing. It's even more difficult in those markets because there's thousands of listings in those markets. And so you're competing against thousands for that one page 1 spot. And meanwhile, in these secondary markets that are more affordable, where you don't need amenities, like our ideal traveler is, we'll have some that are traveling for leisure, but they're also non-leisure travelers. A ton of different reasons why they're traveling. They're traveling for work, for family visits, for funerals, for weddings, for all these different non-leisure reasons. And all of our guests are happy not to have the mini golf course in the backyard or the pickleball court in the backyard. We buy pretty affordable multi-unit properties that are really nice inside, but we're not spending $100,000 in amenities. They're just a really comfortable place that meet and exceed the guest's requirement for that area. So I've watched several big influencer videos over the years, especially focused on short-term rentals. Rob Abasola, actually, is a really popular one, puts out some great information, but he talked about how he sold off his whole portfolio a few years ago because he just wasn't making any money with these luxury properties. And Shelby Church was another one that she said, oh, Airbnb killed me. It doesn't work. My properties failed. I think she's now building more properties that are similar. I don't get it, but there's a lot of influencers like that who have lost a bunch of money with this type of property. And then they go on to say, well, all Airbnbs don't work. And there's such a spectrum of the type of Airbnbs. And just because you bought the mainstream, most Instagrammable type of short-term rental that's a single family property that you had to build up all these amenities on that didn't make any sense from the start, and you didn't run the numbers conservatively to know that it didn't make any sense, now you're saying that all short-term rentals don't work. And meanwhile, I just showed you a awesome 2-unit property in South Dakota that's going to provide 45% cash on cash return. And that's off the MLS today. And the final reason that I think a lot of these influencers are down on real estate right now compared to other asset classes or investment alternatives is that they're not really taking into account the whole host of benefits or financial benefits that can come from buying and investing in the right type of rental property. They're kind of clumping them all together. And I was just watching this video that Graham Stephan and Ryan Pineda did recently. They're having a discussion, and the debate was like, should you invest in real estate or stocks? And Graham was saying stock market is much better. You should not invest in real estate. And he's traditionally been a big real estate investor. Like, he came up and grew his whole following as an influencer by talking about investing in real estate. And he invested in California, in the LA area. And so, yeah, he was one of those guys that did really well when the market was doing well. And now his portfolio isn't looking so great. And he cited how last year he made 40% in his international index fund. And so he was saying that's why it's so much better to be investing in stocks. And so if you're jumping all over and you're trying to chase the 40% return in an index fund, that's ridiculous. Like, look at the history of that. You know that that means next year it's going to be low, or in 2 years it's going to be much lower, because the average in that index fund is probably 8% or less in an international index fund over the long term. So yes, he made that in 1 year, but we just looked at a property that makes over a 40% cash on cash return every single year going forward. So it's not like that's a one-time thing and then you are back to square one. It's going to produce that year over year, and that cash actually hits your account. So it's not like an index fund where, yeah, on paper, you just made a 40% return, but you can't touch that money unless you sell the asset. You're actually getting that cash into your account while at the same time the property is appreciating, while at the same time you're getting huge tax benefits that you would not get in the stock market, and also your principal is getting paid down, and you can use leverage and invest a much higher amount because you're investing other people's money. So those are some of the big benefits, and especially when it comes to short-term rentals, they're not considering the massive tax benefit that comes now as a result of the new law as of last summer, where you can bonus depreciate. It usually works out to about a quarter to a third of the value of the property in year one against your active income. This isn't against passive income or passive losses like it would be with a long-term rental. With a short-term rental, you can write off a quarter to a third of the value of that property against your active income in year one. So you can plan it out to where you're offsetting all of your W-2 or W-9 income in the year and pay zero taxes if you buy the right assets throughout the year. And that's what we've tended to do. We've targeted throughout the year. You kind of estimate how much you think you're going to bring in active income, and then you can offset that with the write-offs from your short-term rentals. I think if you just compare like the performance of one index fund that does surprisingly well in 1 year compared to a typical long-term rental, yes, it makes more sense probably to buy the stock. But if you buy the right short-term rental, the returns are going to be far superior to any other asset that exists, because it's not just like a temporary gain. And I've seen this happen over and over again with the deals that we've done and the deals that many of the people that we've worked with have done in our Blueprint programs. So look, at the end of the day, you can make money doing a lot of different things, right? You could buy a business, you could invest in stocks, you could invest in real estate. And I think they all can serve a unique purpose. But I think the challenge in what overwhelms a lot of people is when people start clumping a broad category together and saying, well, real estate is better than buying a business, or buying a business is better than investing in stocks. And personally, it's difficult for me to hear influencers online saying that real estate doesn't work in 2026 when I can see over and over again every single week people that I'm working with are bringing deals that hit this 1% net type of return. And I can see that this is one of the absolute best paths, most direct paths to financial freedom and long-term sustained financial freedom. So again, if this type of investing is interesting to you, you can book a call with me at the link in the description below. You just go to that link, answer a quick questionnaire at the link, and then it links you directly to my calendar, and you can set up a call, and we can talk through your goals and just see, does the program make sense? Is it a fit for what you're looking to do? And I can share with you the details of the program. Again, thanks for taking the time to check out this video. God bless, and I'll see you in the next video.